Good day. This is the continuation or third part of strategic management and cost systems. So we have discussed so far in part one, the activity-based costing, then the product lifecycle costing. After that, in part two, we've discussed about the strategic profitability analysis or SPA, then also the learning curve theory, and the last one was all about backflush costing, that is in relation to the philosophy, which is JIT or just in time. For this time, this is the continuation. Allow me to present to you the respective PDF file. This is still coming from the book of Franklin Agamata. So this is on throughput accounting. Throughput accounting is basically going to talk about the output or the output of a certain process after we consider the removal or minimization of the bottlenecks or constraints, as we say. So that's why the consideration here is, or the topic here is theory of constraints or TOC, which was first formulated and developed by Goldratt and Cox in 1986 in their book, The Goal. So the theory or concept is simply known as the theory of constraints. Basically, constraints are the bottlenecks or the limiting factors or the backlogs or the causes of the lags on the production processes. So normally they will hinder, as used here, or prevent or stop speedy production. Remember, if we are operating in a global manufacturing scale, we want our production to be huge or big and speedy. So that's the reason why is it that we have to remove, if not minimize, these constraints or bottlenecks. Otherwise, you wouldn't be able to really maximize the production as well as the profitability layer on and sustainability of the business. If you can notice, guys, the strategic management and costing systems really think of the long-term impact or the long-run perspective or long-term goals and orientation with respect about using a system, the management system and the costing system, so that it would really answer as to what can be done in the short-term profitability and sustainability in the long term. So the theory of constraints has 5-step procedure basically. So we have to identify the constraints, we exploit these constraints, we subordinate everything else to the decisions made in the second step. So whatever constraints has been exploited, then we have to support that. 4, increasing the capacity of the binding constraints. So we now have to find ways to solve that and increase it, use it to our advantage. And the 5th one is repeat the process so that we will be able to identify new binding constraints. So basically the process actually continues. So when we identify a constraint, we solve it. So we repeat the process so that we'll be able to know the constraint. And up to such point that, in fact, I don't know if this is going to be laughable, but there's a point there that even the entire organization will be discovered later on as really the bottleneck. And that's going to be something to think about. Anyway, so from a unit level, process level, for sure it's going to be very big or huge later on as to the bottleneck. So the bottlenecks could be in terms of machine hours, direct labor hours, materials availability, market capacity, financial constraints and priorities, talents, and technology. So in other words, the bottlenecks are very related to the resources employed by the organization. So even the raw materials, for example, can cause the bottlenecks. Like, are they available as soon as we are going to produce our products, or we still have to order from our suppliers in which they cannot supply on time? So something like that. So these bottlenecks would really have impact on our production. So example, if it's the process, probably we have to relay out, we have to change the setup of our production area so that we would have lesser time to consume in the transfer of the raw materials from one area to another, or one finished product to be continued to another department or process, and so on. So we have to identify, is it, for example, the human resources or manpower not skilled enough? So we have to retrain them. We have to continue training them if that's possible. And then we have to invest in them. So many things can be done, of course, depending on the constraint or problem. All right. The process of eliminating or unclogging the bottleneck should be made using the overriding criterion of benefit cost analysis as the guiding principle, which is very true, or this is something that we can always relate to, especially in management accounting, that whenever we decide, we always think of cost benefit analysis. So it should be that benefits outweigh the costs. The benefits should be greater than the costs. Then we had, or once that the most constraining bottleneck is remedied, then another most constraining bottleneck that principally hinders the potential of the production process would be identified. So we are going to solve, we are going to find ways to solve the problem, and then the cycle goes on, it continues until, this is the one thing that I've mentioned a while ago, that the maximum capacity of the plant is attained, or until such point. If ever we are able to solve the problem that the overall plant becomes the bottleneck and responding to customer demands. So that's also one thing that we have to take note or about this concept. All right. So that's the introduction about theory of constraints. Now, another introduction or concept is all about the drum buffer rope system. So the bottleneck is the drum. That's the overall pace of the work. It dictates, because if the bottleneck is there, it would stop us or hinder us from doing the speedy or the expedited production or process. Now, because there is a bottleneck, if the issue, for example, is raw materials, there should be a stock available. There should be a buffer, in other words. And then this buffer, of course, should be connected to the drum. So they should be there, the buffer should be there to be able to respond to the drum or bottleneck as soon as it is needed. So the buffer, of course, is like the stock, or let's say the available support or scaffold, as they say, if that is like a building or a brace, for example, a supporting material, because the bottleneck, which is the drum, could again cause a breakdown. So that's the case or point there as to the system: drum, buffer, rope. The rope links all upstream operations to the base of bottleneck. So that those at the front end of the production process will be kept from producing out more than the bottleneck can handle. So basically, we are just going to do the operations within the bottleneck. As soon as we are able to solve such, then we can, of course, go beyond the bottleneck, of course. So the drum is the center point in the production process, and if ever we take that, then all activities preceding the bottleneck operations are considered downstreams, and after that will be upstreams. The downstream should be maintained to operate up to the limiting capability of the bottleneck, while the upstream operations could operate more than the limiting factor's capability. So this is what I said a while ago, that if we go beyond the bottleneck, we can now, of course, consider more operations, more production than before it or prior to it. All right. So the buffer then would support so that we can continue our operations despite the bottleneck that is available. Okay. So for TOC costs, or the throughput accounting, of course, in relation to theory of constraints, it identifies following types of cost. First is throughput or throughput contribution. So basically, this is the difference between the revenues and completely variable costs, which refer to direct material costs only. So this is the good thing about throughput. So basically, the throughput or throughput contribution is like contribution margin minus the direct, minus the direct labor, and the factory overhead, which are components of the conversion costs, right? So I almost said direct materials because remember, direct materials are, of course, also part of the variable costs that are to be deducted from sales or revenues to get the contribution margin. So I repeat, basically the throughput contribution is just the computation similarly to the contribution margin, excluding, of course, the conversion costs composed of the direct labor and factory overhead. So we only have to deduct all costs related to direct materials, including the handling costs. So direct labor is not considered as a variable cost, but rather as a fixed cost in this assumption, theory of constraints. Direct labor cost tends to be more fixed than variable in the present manufacturing setup, which is very true. That in the manufacturing environment, in world-class manufacturing environment, the direct labor hours would like be, or the direct labor consumed and the costs would be support of the manufacturing costs, and we're talking here about the manufacturing costs related to the machine. So remember when we discussed a while ago about capital intensive items related to the industrial revolution that splurged or that triggered more production and more investment in machines because of faster production, faster output, so that we can deliver the outputs on time and to our customers. Then we can also increase our revenues along the way, whether in the short term or in the long run. So those are like basically the reasons why the companies, especially in the manufacturing sector, really invested in the machineries because they realize that although this is going to be very expensive at the short term, but in the long run, it's going to really provide a lot of sources of economic benefits to the businesses. So this is the reason that in this particular case, under throughput accounting and theory of constraints, that the direct labor cost is considered fixed than variable, since it's more on, or it's leaning more on the fact that it is on the factory overhead and that it is fixed because it supports the variability of the production or the manufacturing setup. And then the direct labor cost now is more on, or it's like the salaries, for example, of the production employees, which are in the short run analysis or short term analysis, they are fixed in nature. So this is the reason of this particular statement. Another one is conversion cost. It includes all manufacturing costs except direct materials that are needed in manufacturing a product. So as said, direct labor is not variable but fixed. Again, guys, please do not erase whatever you have learned or we have learned, for example, in our budgeting, short-term budgeting, and also cost behavior, CVP analysis, that the direct labor cost is variable. Yes, that is true because that is short run. And then in the long run, of course, it's going to be variable because there can be changes like increases of salaries and so on, and increases of the number of production workers. Yes, that is very true. But then just for this assumption, for the theory of constraints, that we are going to consider this one. So that's a different island, cost behavior, CVP analysis, and this is a different island. Hopefully that is clear. When we study accounting, it should be that we are going to set demarcation lines. Now, after that, operating expenses. So this encompasses all different types of expenses like selling, like general administrative, finance costs, and other expenses. Investments would be, well, investments can be very tricky, especially in financial accounting. Of course, we have our definition for this one. It would provide long-term capital appreciation. So there would be capital gains, increases of the values like the land, and whatever investments there are could be, of course, intangible investments like stocks, the bonds. But then in finance and management accounting, if we say investments, this would include all items, all sources of capitalization resources, all assets, economic resources, limited resources, scarce, that are being placed or poured into our business. So in fact, raw materials, these are parts of inventories. If this is financial accounting, for sure we would be saying this is not an investment. Yeah, that is true there. But this is management accounting, so we have to respect it. Raw material, work in process, finished goods, even research and development costs. So in business, then, if we think of management accounting, we would realize that if we say anything that has value that we place in our operations, in our business, is investment, right? So especially if it would result to more economic benefits, not just in the short term. Even raw materials, they can be sold in this particular term, but if there are ending units, that would be carried forward on the next year or years. Okay, so I hope that is clear. Research, as being said, their expenses in financial accounting, but here it is a form of investment because it is basically an upward cost. Remember when we discussed this in product life cycle costing. The aim of the TOC is increase throughput contribution while decreasing conversion costs and investment. So good thing in TOC is that for investments here, it encompassed also the other items that would be poured into the business. Then operating expenses, it's the same as financial accounting. Let me go over with that. Conversion cost, because I failed to mention perhaps somewhere. Conversion cost is basically similar in financial accounting, except that for this one, the direct labor has an assumption in which it is a fixed than of a variable rather. Oh my, the pronunciation so of the variable. But then in the case of CVP, cost volume profit analysis, cost behavior and estimation, which is under also management accounting, in fact, it is a variable cost. So that's short-term analysis. And the more in the long run, it is also variable. So basically, even in the same discipline, they have differences in terms of assumptions. So hopefully that is clear. All right. Then the TOC principle, profit is computed then as follows. So we have here the computation. So I think there could be some errors here along the way. So let's just continue anyway the discussions. Profit afterwards. Throughput accounting or TA. So that was a while ago. Can we go back to that part? Throughput accounting, the first item is theory of constraints. So just like that, it is the overall umbrella for throughput. Then the first is theory of constraints, followed by throughput accounting. This is developed in 1989 from the year, what? 1986. So just 3 years, developed by Galloway and Waldron from the theory of constraints. So TA considers only direct materials as the cost of the production process and treats all the other costs of production as expenses. Yeah, that's what I've said in the introduction, that in throughput, direct materials are considered as the costs. And then the others are expenses. So that's okay. Because basically the throughput or output would be the one or the ones, or yeah, if they are outputs or the throughput, but that's already singular or plural. So throughput or the output or outputs can really be the difference and would spell difference if we think of production, because it is something that would form part of the product and normally that is what is visible, while the others like labor and the overhead would just be something that we think that would be part there, because without them the production process wouldn't be complete, the products would not be finished or completed and cannot be delivered to the customers. But then overall, it's the raw materials that are visible. I hope that is the point here. That's why we have to identify, of course, the raw materials as costs. So what's the difference then between theory of constraints and throughput accounting? I have to go back. In theory of constraints, remember, the throughput contribution is identified as the difference between revenues and the direct material costs as the variable costs. And then the result, of course, is throughput contribution less the other items, conversion costs composed of direct labor and the factory overhead, in which there is no mention here as to what will happen in factory overhead. So of course, factory overhead can be both fixed and variable. Okay, operating expenses can also be fixed and variable. But in throughput accounting, so direct materials, that's variable and the only cost of production. The other are expenses. So that's why it can be said that the other costs are combinations of fixed and variable, but it wouldn't spell much of a difference because anyway, they're going to be considered as expenses. So if perhaps the management would analyze through throughput accounting, which is fixed and variable, which can be controlled in the short term. For example, like the variable, of course, can be controlled in the short term, fixed won't. Then in the long run, of course, all costs will be variable. So they can be controlled in the long run. Anyhow, so going back, it wouldn't spell much of a difference because the other costs are expenses anyway. The total cost of production process, that is cost of direct materials purchases, take note purchases, is deducted from the revenues regardless of the number of units sold, and the difference is called throughput. Labor is considered or have been considered fixed and included as part or are included as part of indirect costs. That is factory overhead. So that's why we can have this particular formula here. But before that, we need to know that there is no value allocated to the remaining stock on hand. The philosophy is all the goods are to be delivered to the customers anyway, and the stocks on hand would not stay long in the custody of the enterprise. So perhaps there are really identified customers who will be getting the products, especially the goods, because services, of course, cannot be seen or physically existing on the warehouse of the company. So we are talking here about the goods when we say products. So profit is throughput or throughput minus operating expenses. So throughput is direct materials purchases and the costs. Operating expenses are all other items. So we have here our revenues. So revenues are at 18,000 times 40. Then the direct materials costs are the items at, let me check. So we have here, this is wrong. This is erroneous. 32 times 12, that's 284. So this must be 34,000 times 12. All right, so that's 34,000 coming from materials purchases. So we get 408,000 and throughput is 312,000 then. For the other costs here, so you have the variable conversion costs, including labor, that's going to be there. But we have to know that labor again is considered fixed. So simply to compute anyway the profit, there is no need to really segregate. If you would like to segregate, so we add that to fixed costs. But it's like all operating expenses. 12 times 6, 120, and 60. So we get net profit of 60,000. Overall, whatever method that we use, the net profit should be the same. Hopefully that is clear. And then there's no emphasis on the use direct materials because as said, it should be direct materials purchases, which is also same as backflush costing, if you can remember, wherein we focused on the RIP, raw and in process, and the focus is on the raw materials purchased, not used. All right. The emphasis of TA. TA is not only concerned on recording transactions and details. Yeah, that's very true. It focuses on the clear strategy, follows also on which element of the production process should be emphasized. And clearly that is, if I will not mention, then you can pause this one, of course. Okay, and the answer is, of course, the direct materials purchase. That is what is being, of course, considered or emphasized. And also first on the throughput, the difference between the revenues or sales and the direct materials purchases, then the minimization of the stocks, and of course, the control of the costs. And stock minimization and cost control are really emphasized in management accounting. Okay, so after that, okay, we're already informed about throughput, the difference. The emphasis of throughput is analyzed in relation to the bottleneck. So what is really causing the delay or backlog or the delays of the production? Okay, so the emphasis of throughput is analyzed in relation to the bottleneck. This one, the return per bottleneck, as said, is not only raw materials. By the way, for bottleneck, it can also be machine hours, could be any resource in the company that is being used in the operations. The return per bottleneck time is sales minus materials cost. So basically, this is the throughput divided by time period, and we get the return per bottleneck time. So basically, what is our profitability over the bottleneck? If the bottleneck operations are used to produce two or more products, the aim is to keep the bottleneck operating at 100% performance. And if possible, we cannot be 100%, then we have to find ways to alleviate the constraint. So in this case here, in this problem, we have to compute the return per time period per product on the bottleneck. So for product A, we have the sales price minus the direct materials cost, 120 minus 30, that's going to be 90 divided by the time, right? So the minutes used to get the return per bottleneck times 120. This is not aligned. 120 minus 30 is 90. That's the throughput. Divided by 30 equals 3. So 3 pesos is the return per bottleneck minutes spent in the cutting department. 4 and 3 here, and 3 and 1, these are costs, by the way, per minute. Take note, the return per bottleneck time is with respect to the time consumed. That's the bottleneck. And here also, 80 minus 20 is 40 divided by, sorry, 60. Oh my, 80 minus 20 is 60 divided by 15, 4. Okay, 80 minus 20 is 60 divided by 15 is 4 pesos. The return per bottleneck minute reflects the profit potential of a product per limiting time of the bottleneck. So in other words, the higher the return per bottleneck, then the more that it is prioritized with respect to the limited time. Because you only have limited resource, so the higher the return would there be, then the more that it is prioritized. Then what if the enterprise would find ways to increase the available time for machine hours? Also, we have to prioritize the departments that would produce the higher return per bottleneck minute, or the throughput per bottleneck minute in this example. So that is product B, which is 4 pesos per minute, as opposed to A, which is 3 pesos per minute. Okay, what about for throughput cost and effectiveness measure? So for TA ratio, that would be the value added per time period divided by the conversion cost per time period. So you have here the throughput, the return per bottleneck time divided by the conversion cost. So what is being drived at here is that we would like to know as to what really is the return over the costs incurred in order to finish the throughput. That is the point. Also, we can view it as we want to know how much really is the return or throughput over the cost that would be associated of making the throughput. All right, that could be also another way of saying it. In profitable operations, this ratio is normally greater than 1, and we want to increase this ratio as much as possible. If it is lower than 1, so meaning the company is losing money. Take note, that's just sales minus materials cost, and that is already less than 1. So meaning our throughput is lesser than the conversion. We spent a lot for the production, so that is something that we have to take note. We want it to be at least 1 or higher. Because take note, that is still not including expenses. So can you imagine, like conversion cost, just the conversion cost and it's just 1, but that is minus the operating expenses, then we will get negative amount or loss. Next is current effectiveness ratio. That is standard minutes of throughput achieved over the minutes available. So clearly, what has been achieved using the throughput in terms of the time and the time really available. So effectiveness is an important ratio because we would be able to know as to the extent of how we are able to achieve our goals. So with the minutes available, what is really the achieved standard minutes and compares it to a current standard. All right, so that's it for throughput accounting with the theory of constraints and the TA later on. After that is customer profitability analysis. This is the last part of our discussions for strategic management and costing systems. Customer profitability analysis is very important. This is having the acronym CPA, not Certified Public Accountant, of course. This is a new trend in management accounting in which we have to determine accurate costing per customer, not only per product, so that we'll know how profitable we are in terms of a customer. So customer profitability analysis is, of course, measuring the value of transactions with customers by detailing the related price and cost in order to know the level of profitability and take needed managerial actions to improve the overall performance of an enterprise. So I've read that lengthy definition, but clearly we would like to know how profitable a certain customer is, what are the costs associated, of course, prior to getting the profit or loss. Of course, as much as possible, it should be profitable. And of course, we also like to know the revenue. Normally, we have the revenue because remember, we have the schedule on our records for the sales or the accounts receivable. So the revenues are there, but in terms of how profitable are we on this particular customer, so we would like to know also so that we would know like which customer really that we have to focus into or which customer in which perhaps we can find ways to be able to increase sales. So we do not like eliminate immediately if ever we found out that a certain customer is not producing or giving us or providing us a lot of profits, or if negative for the meantime. We have to scrutinize further before stopping any contract with that customer. And then each customer needs or sometimes demands specific service to get acceptably satisfied. As discussed in the previous chapter, every customer is a king. Without the customers, the business cannot have profits and cannot continue operating in the future time. Then customers may be classified as here follows. So anyway, it's like already introduced here, but we will just go to the next figure later on, this one. So the objective is to serve accepting customers with corresponding low cost of service, perhaps because they are located close by or do not place rush orders and are prepared to accept high price. So that's also the reason. Meaning we can adjust certain components of the costing because of certain qualifications that a customer has. So example, those, they do not place rush orders. So basically they do deserve low cost. And perhaps you can also minimize the price. That's also one thing that we can remember because some customers wanted this price and so on. Then many large retail organizations belong into the demanding category. Of course, they have several demands to be answered to in terms of products. Then the suppliers are willing to accommodate rush orders, change production methods that suit their specifications, and so on. So meaning we have to really adjust to their demands, but of course that would have impact perhaps on the prices. Then profitability can be different between customers, of course, because there are plenty of concerns. So here is a graph or a figure showing about the classifications of customers. So they can be demanding. So in terms of the price, by the way, which is at the x-axis, price customer is willing to pay. And on the y-axis is the cost to supply the customer. For the demanding, let's begin, demanding customers, which is, by the way, introduced here, customers may be classified as follows. You have demanding, they have low willingness to pay for the price, but they are going to be dealing with high cost because they are into rush orders, immediate delivery. So we need to adjust to them. They're very costly, but they are not willing to pay the high price. So that's the sad thing there. Next is price conscious. So they want low prices and they are low cost or low maintenance customers. So it's okay, right? We can adjust for them. Next is service conscious. They are, of course, willing to pay high price, but they also have high cost to maintain or sustain. So they want the best service as much as possible. And finally, the accepting customers. They're willing to pay the high price, but they're willing to wait. Okay, so these are the classifications of the customers. Now, as being said a while ago that profitability can be different between customers because some customers would demand depending on their classifications as to the higher costs. Then sometimes others would be asking for a lot of discounts, promos, etc. Or we will be spending a lot of promos just to get the market. Next, here is a sample problem showing to us a customer profitability analysis. So we can actually determine as to how profitable we are on the different customers. In this case, we have the selling price per product. Then we have the following items, then the cost and the cost per activity. So what is the profitability percentage for each customer? All we have to do is for each customer, determine the operating profit, and then we can determine the profitability ratio. So I suppose that is operating profit divided by revenue. So can we check that? 6,380 divided by 15,000. Okay, that's it. 0.42533 dot dot dot, or that is 43%, rounded off to the nearest whole number. So that's 43%. And among the profitability ratios, which are computed basically from operating profit divided by revenue, so we can make a rank. The first should be, of course, the highest profitability ratio, and the lowest would be the lowest profitability ratio, the lowest in the rank, I mean. So first, second, third, fourth. So that's ironically also A, B, C, and D, or coincidentally. And then what about the customer profitability curve? By the way, for 1 and 2, the profitability analysis. Okay, so profitability percentage and the rank. What about the curve? So in terms of product A, we can compute the marginal profit or operating profit, all right. Units sold, 60,000 here. The cumulative percentage is units sold, by the way, are given, okay. What about the costs? So we have to compute them respectively. So sorry, because they're not given, so we have to multiply. The example, sales visits, we have for product A2, so times the cost of sales visit per visit, of course, 210. Then this is 60 times, this is 30, I suppose, 30, right? 30. It's not clear though. 2 times 10, then normal delivery cost and the kilometers per journey. So let's check. Delivery is 2 per kilometer. So 2 times 20 times the number of deliveries. So that's why it is shown here. For product handling, that's 0.10 times the number of units. So if you can notice, they're aligned. Number of units, product handling, sales visit, order placing, 60 times 30. For the normal delivery cost, this is the one that is quite unique because it is 2 times 10 times 20. The rush delivery cost is 200 times 1. All right, because it is just like an additional cost to be imposed. Okay, so I hope that is clear. It's 200 times 1 for A. It's 0 here, and 200, it's times 2. So there could be some missing item here, like the rush delivery. Probably, let's just say that it's given here in the problem. So anyway, we computed the marginal profit and the units sold. Then we get the cumulative units sold for each so that we would get the cumulative percentage. So if we have product A added to B, so that's 7,480, then 140,000 total, which is 60,000 times 80,000, 140,000. Can we compute the cumulative marginal profit? That's 6,380 plus the 7,480. That's 13,860 divided by 140,000. So guys, kindly compute about this one. All right. So instead of doing that to get the percentage like marginal profit divided by the unit, so it's not how it is. So perhaps you are used to here in computing the profitability ratios. Instead, this is quite something that is not shown here. So we have to do the analysis. Anyhow, how do we do that? That is basically the total units sold, meaning the cumulative sales or units sold for all products A to D. And whatever is the units sold cumulative on that particular rank, we divide that by the respective total cumulative units sold. So what do I mean? Example, for product A, the cumulative units sold is 60,000 because the prior to that is 0. Of course, no data prior. So 60,000 divided by the total of units sold, that's 60, 80, 170 in thousands. That's 310,000. We can confirm that by computing. So okay, indeed, it's 310,000. 60 divided by 310, that's 19%, rounded off. Then 140 cumulative is the sum of product A and B. So in other words, to be able to make the customer profitability curve, we have to make this particular rank or ranking table for the products A to D. And we have to supply, of course, the details. Then we have to place on top the first in rank up to the last so that we will be prioritizing the products that are producing more profits to the company. All right, so operating profit divided by the sales. Okay, so here we have the 60,000, that's done. 140,000, okay, total from 60 and 18,000 divided by 310,000, that's 45%. Let's check, okay. Then 140 plus 100 is 240. 240 divided by 310, that's 77%. And so that the total is, of course, 210,000, and that's 100%. What's the lesson here? If we can see the graph here, the x-axis is cumulative percentage, the y is marginal profit. We can notice that with this data, the 77% is the total from products A to C, and therefore we can say that almost 80% of the products constitute the highest profitability for the company. And therefore, that's why the last section of this particular book discusses that the customer profitability curve is depicting the Pareto analysis, the 80%, 20% rule, wherein 80% almost of the customers at 77%, very close. Actually, it's like 2 point something percent because of the rounded off figures difference from 77 point something to 80%, producing the highest marginal profitability. And this also means that the 20% or lesser is something or more because it's rounded off. So it could be more like 77 point something percent. Then that's 20 plus percent more the difference. Or let's just say 100 minus 77, that's 23. 23% is something that we should be investigating. So we have to find ways to be able to attract them to contribute more to the company. Perhaps we can reduce the costs for them so that we can have more units delivered to them. So increasing the sales by having lesser prices for them. And then we can also have increasing the unit sales price and then net of the discounts. So that's also one thing that we can think about. So if the price before net of discount is 10, we have to increase it to 12 so that we can have higher sales. But it is not advised, technically feasible, to drop the low margin customers because it contradicts the existing customer strategy of the business just because the situation is tough that we are now going to abandon them. That's a no-no. Or perhaps there are some complementary effects to other customers. If, for example, we are going to remove them, so that would also have impact on the sharing of respective cumulative percentages for profitability of the other customers because once one is removed, so the analysis could be different. And aside from that, we might also be giving them some other complementary products. I would say, although that's not really connected here because I said complementary effects is that when one has been given a certain action, it might have a certain compounding complementary effect to the others. So that's the point here. All right. So that's why complementary effects. Hopefully you've learned something from the 3 sessions. This is the 3rd session, by the way, for strategic management and costing systems. So thank you very much for listening, and I'll see you next time for another session. Bye for now.